Good afternoon, and welcome to this week's Midweek Money Matters, brought to you by the Pennsylvania Department of Banking and Securities. My name is Katrina Boyer. I'm the Investor Education Coordinator for the Pennsylvania Department of Banking and Securities, and I'm thrilled to have you here as we talk about how to buy a stock. We are continuing with our how-to series throughout the month of August, so you don't want to miss out on some of our other how-to sessions. We are recording today's session, so I ask that you remain muted throughout the remainder of our session. At the end of the presentation, I'll stop the recording and invite you to ask any questions that you may have live at that time. So today we're going to be covering some information about the steps that we need to take in order to buy stock. But first, we have to understand the different types of stock there are and what kind of research we should be doing in order to do that. Then we'll talk a little bit about how to open an account so that you can start to buy those stocks. We'll talk about how many shares you may want to purchase, and then we'll talk about some vocabulary terms that are important for us to understand so that when we start that process of buying and selling, we are able to do that. So did you know that there were different types of stocks? And knowing the type of stock that you want to purchase and knowing what you're looking for can really help us to narrow down those choices. You can see here on the screen the 6 different types of stocks. I am going to spend just a couple minutes talking about each of them through the next slides. So the first type of stock that I want to talk about is an income stock. Typically, income stock are from larger companies that have already done their growing and they're not using much of their profits to reinvest. That typically will involve them sharing their profits with their stockholders in the form of dividends. So if you're looking for a stock that's going to pay you a regular stream of income, an income stock is maybe what you're looking for. Another type that we want to talk about are growth stocks. Growth stocks involve smaller companies that are still working to sort of make their mark in that specific market that they're going into. They're typically focused on growing their company, so any profits that they make are reinvested so that they can grow the business and increase the share of that particular market that they have. So if you're looking for a company that is trying to grow its size and you're looking for perhaps the value of the stock to increase, a growth stock might be where you want to start. The next 2 we're going to talk about are value stock and small capital companies. So a value stock I like to think of as sort of an on sale stock, because when you look at the trading value on the market and then you look at the company's profit and loss and some of the other information that's available when you start to do that research, you realize that the value of the stock is trading lower than what you think the company may be worth. So that's why I kind of think of that value stock as that stock that's on sale. The 4th type of stock that I want to talk about is a small cap stock. It's also called a small company or a small capital company. These companies are typically smaller than other companies that have been established much longer and have a much longer history. They don't have as much value overall for the company. But it's nice because they often or commonly perform better than average larger capital companies. But we have to keep in mind that while the performance may be higher, they're also going to be subject to the bigger fluctuations of the economy. So we have to make sure that we have that balance and we're okay with having that small cap investment. And that's where having a diversified portfolio is going to come into play. And we're going to talk about that in just a few slides. But next, I want to talk about the other 2 types of stocks. The 5th one that I want to talk about is called foreign stock. Basically, as it sounds, it's a stock that is also issued buy any company that is not based in the United States. So if the company that you want to buy stock from is outside the United States, then it's considered a foreign stock. The last type of stock that I want to talk about before we move on is cyclical stock. And those are stock whose business profile kind of ebbs and flows with the flow of our current economy. So, one way that I think about that is when we think about the housing market and we see it kind of ebbing and flowing. So, if you're investing in a company that maybe offers materials for building, perhaps when the market is doing well, you'll see bigger profits. When the economic cycle is down, like we're just coming out of the pandemic, I know that there's a lot of things that are much more expensive than they typically are. So that's sort of the big picture of a cyclical stock. Another example of a cyclical stock that I think of often is maybe investing or maybe in a company that has a lot to do with fun times or things that we maybe don't spend on when we are in an economic downturn. Maybe we don't buy as much coffee. Maybe we don't buy the same kind of name brand clothing. So again, the company value, the stock value is going to cycle with the economy. So that's a really great way to think about cyclical stock. And again, if we talk about the 6 different types of stocks that we've covered, growth, income, value, small cap, cyclical, and foreign, hopefully you can see where spreading out those investments throughout all of those types of stocks can be really helpful in protecting the assets overall. So let's move on to talk about the approaches that we can use to purchase stock. So there are 2 different approaches that I want to take a look at today. The first one is the top-down approach. And that's where we kind of look at the bigger picture. We look at the economy, the state of the economy now, overall, including different markets and different industries. We're sort of looking down at that bigger picture and kind of trying to make a decision based upon what's happening on that bigger scale. The other type of approach that I want to mention is what's called the bottom up. And that really is looking very closely at each individual company that you may consider investing in and taking a look at how it's performing alone and in comparison to the rest of the market that it covers. So when you're looking at the bottom up approach, you want to think about the financial ratios, the individual earnings for that particular company. How much are their sales on a regular basis, and are they continuing to grow, or have they become stagnant, or even worse, maybe they're losing value? Again, just because a stock is maybe not doing really well doesn't necessarily mean it's not going to come back. So perhaps investing in that type of company might be something that you want to look into. There's no true right or wrong answer because all of us as individual investors have to take on those considerations on our own. So make sure that you think about, the type of approach that you might be interested in taking, or maybe your approach is going to be some mix of the top down and the bottom up. I think it really just depends upon our style and how comfortable we are in general reviewing and researching and making different types of considerations. So, where do I start is one of the biggest questions that I get from consumers when I talk to them about investing. So, when we're starting to think about specifically investing in stock, we want to make sure that we are researching the stock itself. Make sure that you're looking at different finance websites. You can actually go directly to the company's website. When I was putting this presentation together, I started to look at different individual companies. And what was really cool is I found a tab specifically for investors specific so that you could see sort of the reports that they have, some of their long-term goals. You can see their past history, and you can kind of get a really good idea of how that company is performing and the information that they're putting out there. Another option is to take a look at the different markets and exchanges. You can go to the New York Stock Exchange, NASDAQ, whichever, and you can type in the name of the company that you're considering investing in. And you'll be able to see an amazing amount of money, or excuse me, an amazing amount of information that's going to be available to you to show you how that market has, how that particular stock has ebbed and flowed. It will also show you information about other businesses within that industry and give you some of that kind of perspective as well. The last type of place that I want to suggest that we talk about is the regulator websites. So the Securities and Exchange Commission is a really great place to learn about the company that you're considering investing in. So again, type in the name of the company, and when you go to the sec.gov's website and type in that information, it will actually bring you to the Edgar site, which will tell you, it will show you all the different documents that that company has filed with the Securities and Exchange Commission. Those are documents they're required to file, and they are legally bound to provide that information. So that's another great way to be able to get information about a company that you are considering investing in. Again, great way to find information. So as you're starting to research that information, check out the investor information tab of the company's website. Review the company on the market where it's listed. And then again, review the company filings on sec.gov. Finding information from multiple different sites goes a long way in giving you that bigger overarching picture, because certainly the information that you see on the company's website is going to be different than what you see on the SEC's website. It's also going to be different when you look at the market in general. For, let's say you're considering investing in a health and beauty product company. So if you take a look at company A and compare it to what other health and beauty companies are doing, that can kind of give you, again, that bigger overarching picture. So you can take a look specifically at the company, but also look at that general market as well. Again, it gives you that bigger picture, and it's a great way to be able to make those informed decisions. So when you're looking at those things, make sure that you're considering the price to earnings ratio. That means, what's the price of the stock compared to what the company is earning? It's a great way to sort of see how that company is producing it and what that looks like. But we also want to look at the company's products, the market share and its dominance. If health and beauty company A has a 50% dominance of the market and it's doing really well, that's a kind of a good indication that you can count on that to continue to happen. However, if you're looking at a company that's smaller, maybe they don't have quite the market share, but maybe their products are really, really good. So make sure that, again, we consider all aspects of that point of view, because we don't want to make irrational decisions when it comes to purchasing or selling or trading stock. We want to take a look at the revenue that's coming in and the expenses that are going out. So take a look at that net profit margin, the profit compared to what the company actually brought in. Again, these are just a few of the key considerations. We could talk for hours about each of the different topics that we cover throughout Midweek Money Matters. So I always make sure that I really encourage people to take the information that I provide and run with it and take it to the next level and learn more. But so first things first, we've done our research and we kind of have an idea what stock we want to purchase. But before we can do that, we actually have to have an account that allows us to buy and sell on the market. So that account is called a brokerage account. You may recall that that allows you to deposit money that you can use to buy and sell your stocks or other types of investments. on the market. So it's sort of like this, I kind of think of it as the savings account that puts me in touch with a broker dealer who's able to help me buy and sell my investments the way I want to. So how do you find a brokerage account? Well, I always encourage people to use their favorite search engine to find your options. And we're going to talk about things that we need to consider in the next couple of slides. But understand that opening a brokerage account takes about 15 minutes, and you are going to be required to provide a lot of personal information about yourself because the brokerage company wants to make sure that you are who you say you are, but they also have requirements to fill in order to satisfy the regulators. And they also want to know where they're going to get their money. So you're going to have to provide information, your social security number, date of birth, driver's license information, or your ID information. You're also going to have to provide bank account information and probably employment information because the reality is many people set up accounts so that their money goes directly from their employer into their brokerage account or from their financial institution into their brokerage account. So be prepared to provide that kind of personal level information so that you're not taken by surprise when they ask you for that information. Now, when you're opening that brokerage account, I always encourage people to investigate the professional and the firm that you're considering using. Make sure that you are going to brokercheck.finra.org and you type in the name of the firm or the broker that you want to use and make sure that they're licensed. You can find out information about how long they've been in business, what series exams they've passed. You can find out if they've had actions taken against them. All kinds of information is available on that broker check. The other thing you want to make sure you understand is the different types of investments they offer. Many brokerage firms offer many different types of investments, but they don't all offer the same. So make sure that you understand the investments that they offer and that those are going to meet the needs that you have for what you want to invest in. Also, if you have the opportunity to talk to a professional, either by text message or chat or however, ask them questions. Make sure that there's a good fit if you're working with a human. And then finally, I always encourage people to make sure they review the client or customer relationship summary. And basically, that is going to tell you how the firm is going to get paid. It's going to tell you if they have any conflicts of interest that you may want to know about. It's going to tell you if they've had actions taken against them. And what's really cool about the relationship summary is that the regulators have sort of outlined how that needs to look so that you can see consistent language throughout in all the different headers. So you can compare, if you're maybe considering two different firms, you can compare each of the documents in a way that makes sense. So you can kind of look at apples and apples instead of apples and grapefruit. So make sure that you kind of, take those things into consideration before you open that account. Once you've opened the account and there's money available for you to be able to start to make those stock purchases, make sure you understand the language. The lingo is really important because it can be really confusing. The next slide, we're going to talk about a few of the different terms, but it is certainly not inclusive. So I always encourage people to, again, review the different information. I do have the source that I use to come up with these definitions. I would encourage you to get a copy of today's PowerPoint presentation and explore that article more along with others. But first, let's talk about the different terms that we need to be aware of. So the ask is the price that someone who's selling a stock is willing to accept for it. So as a buyer, I need to know the ask. What are other people who are selling that stock willing to sell it to me for? The bid is the price that buyers are willing to pay for the stock that's being offered. Now, the spread is the difference between the highest bid price and the lowest ask price. So it's kind of important to understand those things. A market order is where you go in and tell your broker dealer that you want to buy or sell a specific stock at whatever the best price is right now. The limit order is a request to buy or sell a stock at a specific price. So if I want to buy a stock of XYZ toilet paper because man, they have the best toilet paper, but I don't want to buy it until it gets to the point where it's sold for $45. Now, if it's selling at $47 now, their limit order is going to wait until it hits that $45 mark or is better. So understanding some of that terminology can go a really long way when you go into your broker dealer account and you tell the broker dealer what you want to do. Again, I would check out the NerdWallet article that's sourced here because there's a whole lot more than this. This really is just the tip of the iceberg. So I encourage you, again, take what you can from today's session and make sure that you learn more as you go forward. So I mentioned that we have to consider stock diversification. The reality is we don't want to put all of our eggs in one basket because what happens when that basket becomes too heavy or it becomes weak and it crashes? All of my eggs are broken. It's lost, right? So if we diversify and spread our eggs or our stock into lots of different baskets, those different baskets can help support one another and can make sure that our assets are protected. So we may want to diversify our investments based on a lot of different things that we're going to consider. Most industry professionals suggest that a well-diversified portfolio is somewhere between 20 and 30 different stocks. That's a lot, isn't it? But don't worry because you don't have to do it all at once. Investing in the stock market can be little bits and pieces as we go along because we're going to use stock and our other investments as a way to reach our long-term goals. So we're trying to reach those things that we're not going to be planning for at least 3 to 5 years. Many of us invest for much longer term, either to build wealth or pay for a retirement. But as we start to think about diversification, we want to think about different sized markets. What about the sizes of the companies? Maybe I want to have some stock in some smaller companies and some larger companies, maybe some in foreign and domestic. Another category that we don't even mention yet is companies that are concerned about the environment. I think that's going to end up being its own special presentation because that's a question that I've been getting pretty frequently. So as you start to think about diversifying your portfolio, it may pay to actually go back and look at the different types of stock that are available. Those 6 things that we talked about early on: growth, cyclical, income, a value stock, spreading out our portfolio in all of those different types of stock kind of ensures that the value stays and continues to grow in a way that is helpful. So make sure that you stop to think about the fact that if you put all of your money into your favorite clothing line and suddenly that clothing line is out and the next designer is in, and suddenly you've lost an incredible amount of value because you put all of your eggs into that single basket. So I think that diversification really is important, and taking into consideration all of the different types of stocks, the size, the ages of the company, where they're located, can be really helpful in ensuring that we have that well-diversified portfolio. There is a ton of information out there I most often provide resources that are government related or they come with some other sort of backing. I always like to provide those types of resources, but I felt like today's presentation sort of justified providing more information. So the information, the different logos that you see here, these are all sources that I've used from time to time. It certainly isn't all of them. So I encourage you to take a look at these, find other resources, learn other websites, but understand that if it's not a government or or similar organization, they may be paid for different things that they review on their website. But what's really cool is when you click on any of these, they're pretty open about how they're paid, and any kind of commission or compensation that they may get if you click on some of their links or if you take advantage of some of their advice. So it's important to understand that these websites sometimes have other thoughts. It's certainly not inclusive, and they have great resources, but take them for what they're worth. But I do want to tell you about the regulatory and government resources. So I mentioned the Securities and Exchange Commission. Their website is sec.gov. They have that site that you can take a look at where you can type in the name of the company and you can see all of the reports and things that the company is required to submit on a regular basis. The Financial Industry Regulatory Authority is finra.org. That is the regulating body for investment professionals. It's their self-regulatory body. So they kind of all hold each other accountable. But they have a really great website at finra.org/investors. And then the last resource that I want to provide you with today is the North American Securities Administrators Association, also called NASA. And they have a website called nasa.org/investor-education. Again, really great non-commercial resources that you can go to learn about saving and investing, investing in stock, and some of the other different topics that we cover in our regular weekly series. I would be remiss if I didn't tell you about our Office of Consumer Services. They're available during regular business hours. When you call 800 PA Banks, a real life person will answer your call. They're happy to help you with answer any questions that you may have on some of the topics that we've covered. They also are able to answer questions about some of the other things that we regulate, like financial institutions, banks, and credit unions. If you have an issue with a check casher, pawn shops, car dealership, mortgage originator, or other type of consumer discount lender, if you have problems with your investment professional, or you just aren't certain what's happening with those types of companies, you can give us a call, and our consumer services staff are willing to help you to understand those questions better. Next week, I'm so excited because next week is our 100th session of Midweek Money Matters. So continuing with that how-to series, we're actually going to be talking about how we can learn more sort of about that overarching saving, investing, and protecting our assets. So you don't want to miss that exciting session. You can register for that at padobs.eventbrite.com if you haven't done so already. I would encourage you to participate in that because it's going to be a really great session and a terrific landmark for us to be crossing in the midst of this pandemic as we continue to work through that. So make sure you check that out. I do want to thank you so much for your time. Again, my name is Katrina Boyer. I'm the Investor Education Coordinator for the Pennsylvania Department of Banking and Securities. I am going to stop our formal recording now.